What's really good? We back at it again. Weekly videos. I'm trying to get back on track. It's like the third, fourth video I put out, pretty consistently on a weekly basis. You feel me? But if you want daily videos every day, tap the link, join the Instagram and the TikTok. You feel what I'm saying? And join the Discord because we finished this week with another 75% win rate. 3 wins, 1 loss. Give all praise and all glory to God, Jesus Christ of Nazareth. And yeah, you feel what I'm saying. But in today's video, because the majority to an extent was about like a 50-50 just overall vote. But I'm going to be going over an educational video talking about POI zones, point of interest, key areas that need to be marked out so we can avoid getting screwed over. And we can use to our advantage amongst the main confluences, which is structure, price, action, liquidity, and imbalance, so that we can genuinely take a genuine A+ trade. You feel what I'm saying? Alright, so yeah, you feel me? So let's get straight to the video. Alright, so first things first, now that we're on the charts, I want to go over a couple of things before I get into the actual marking out and whatnot, okay? Which are, what is a POI zone and what is the importance of a POI zone? Because a lot of people, they ask me questions like, what is a POI zone? What is a POI zone and whatnot and whatnot? And ultimately, that's what I'm going to be telling you in just a freaking second. So calm down, you feel what I'm saying? But ultimately, what is a POI zone? A POI zone is a blind spot that is based on a zone that based on analytically and statistically speaking, an area that you could get screwed over, or you could use it as an advantage point within your trade. Ultimately, it's just an area that needs to be marked out so you know what's in the area that could screw you over or it could, quote unquote, help you out within your trade. That's the whole point, because if you don't have it marked out, then you might be in a beautiful move to the upside. Then guess what? It taps into a POI zone that you didn't mark out, and then boom, rips all the way through. You're fraud. You feel me? That's the whole point of marking it out. Or maybe you're in a trade and trying to get into a trade, you don't know what price could react off of. You mark it out. Oh, boom, beautiful. You see price shift structure in the lower time frame. And then you take it up, take it down, whatever. You take it around, however you feel. You feel what I'm saying? That's the overall importance of a POI zone. Otherwise, it means ugats. It means freaking nothing. All right, then. Now that we know what a POI zone is, how to throw the glasses on, but now that we know what a POI zone is and what is the importance, now we need to understand what POI zones we will be using and how to mark them out. First POI zone that I want to go over is supply and demand, okay? Now, what is supply and demand? These are areas based on impulsiveness when there is no news and no reason for price to move drastically in some whichever direction, like we see over here with these big 1 hour candles. When price is moving drastically in one direction, just out of nowhere, with no influence of news, and I mean super volatile and tons of volume, that lets us know that that is a quote-unquote impulsive move because there was no news, meaning that was clear as day manipulation. And the reason that price does that is to store big orders within that overall supply or demand zone, which I'll show you how to mark that in just a second. So then when price does come back to pull back within that zone, it fills in all those orders and tends to bump back up in that same direction, or sometimes it can break through it, pull back, retest in that same zone, and then dump all the way down. Kind of like support and resistance. When it comes to breaking resistance, it becomes support. When you break support, it becomes resistance. When you break demand, it becomes supply. When you break supply, it becomes demand, okay? Obviously, it's just the overall basis is going to be completely different, okay? Especially when it comes to marking them out, okay? So now that we understand what supply and demand is and what it's based off of, now we need to learn how to mark it out, okay? And what to look out for, okay? So obviously, as I said, we're looking for impulsive candles. This is an impulsive candle because look at the size of this candle compared to this candle. When there was no news, that is clear as day, impulsiveness, manipulation out of nowhere because there was no news, okay? Meaning, we are going to mark out the previous candle's high and low point. Previous candle's high and low point to that big impulsive move that is going to be our supply or demand zone, okay? Now, what determines if it's going to be supply or demand depends on the overall direction of impulsiveness. If we have bullish impulsiveness, like we see here, we had an impulsive move to the upside, to the buy side, to the bullish side. That would be a demand zone because obviously when there's demand, there's going to be a lot of buyers. And then when there's supply, there's going to be a lot of sellers trying to sell the supply to the people who have the demand so people can buy more. Supply and demand, okay? And then obviously a supply zone is going to be complete opposite. It's going to be an impulsive move to the sell side, to the bearish direction, like we see right over here. We had this big impulsive candle compared to the previous candle, letting us know that we had impulsiveness, and we can mark this out as a supply zone, because again, a demand zone is an impulsive move to the upside, and a demand zone is an impulsive move to the upside, and a supply zone is an impulsive move to the sell side. Okay, now what we look for within these POI zones is we look for a pullback, retest, and reject off of it. Now we're not going to get in off the first straight retest and reject, because look what you would have got caught up with if price tapped into it and you immediately got in right here. Boom, you would have got stopped out. Okay, you want to wait for price to do the ultimate 4 things in regard to that overall direction within that trade, because ultimately price tapping into a POI zone and reacting strongly, it means ugats. It means nothing. That is not enough confluences to get into a genuine A plus strategic setup. Okay, what you want price to do is to tap into it. You want the price action to show you that we should be going to the sell side. Amongst that, a structure shift on the lower time frames, sell side manipulation and sell side distribution, pressure and momentum within that overall directions, where the price action and understanding of what the stories the candles tell you come into play, and ultimately your target, liquidity and imbalance. If you have those 4 things in your favor after price taps into that POI zone, then you're Gucci. Because look right here, we tapped into the POI zone, we shifted structure in the lower time frame after we broke past this 1 hour candles wick. Also, price action is letting me know that we are kicking in with sellers based on the distribution of sell side pressure compared to the lack of momentum within the previous bullish candles. And guess what? I'm getting in after we shift structure. We show signs that we're clearly going to drop down. And guess what? I'm taking TP. We're taking TP. Usually, majority of the times, you'll see price move at least 50% within a big old fair value gap. But there's also another POI zone within the area perfectly where TP was, which is, guess what, a structural level, which is a POI zone I'll be going in just a little bit. Okay, so we will run back to this instance in just a second. Okay, but overall, boom, that beautiful trade, 1 to 2 RR. You could have tightened up your stop loss, put it in the break even. Would have been a risk-free trade. Not because we tapped into the supply zone, but because we had 4 other important confluences leading up to that overall trade. And we were able to use that POI zone to our advantage to get into that trade. Otherwise, you would have missed that opportunity. You feel what I'm saying? So this is a case of, okay, we were able to take advantage of this and avoid possibly missing a beautiful opportunity. We're going to go into the second POI zone, which is a fair value gap, or what could be in the process a inverse fair value gap. Okay, now the biggest thing that I see a lot of times when it comes to the fair value gaps is, how do you mark them out? You know, there's a lot of family members I'm trying to teach how to trade. There's a lot of people I'm trying to teach, family, friends, and over the, calls within my free mentorship. How do you mark out a fair value gap? How do you know if it's a fair value gap or not? Well, I'm about to tell you. You feel what I'm saying? So just chill. Ultimately, with the fair value gaps, what you want to look for is a 3-candle segment when price leaves an opening within the second candle based on the first and the third candle, because each and every single candle segment should do like we see right here. Let me get it over really quick. Okay, every candle segment should do this. You see how price, the first candle, we had this wick, and the third candle we had this wick, filling in the overall body of the second candle. That's what price should do every single time, just like you see all the way up here. How that second candle continues to get filled in by the third candle's wick and the first candle's wick. That is a regular, that's just a regular balanced market. Is when the first candle's wick and the third candle's wick completely fill in that second candle's overall range of body. Because, and if not, we form something like this. You see how this wick and on the first candle and the third wick of the third candle doesn't fill in the second candle. It does not fill in the middle candle. Look at here. This wick of the third candle and this wick of the first candle fills in the body of that second candle. But this wick of the third candle and this wick of the first candle does not fill in the body of the second candle, meaning we have to mark out where the wicks failed to meet, which is right here and right here at the top and the bottom, or it could be the bottom and the top, depending on the overall direction of this fair value gap being formed. With the bullish fair value gap, it's going to be at the top of the first candle, bottom of the second, third candle. And then a bearish fair value gap is going to be at the bottom of the first candle and the top of the third candle, like we see over here. It would have been at the bottom of this first candle, top of the second candle for a for a bearish direction. And then obviously this is a bullish instance right over here, okay? And that's what you would call a fair value gap. Now, how you work with this is similar to the supply and demand zone, similar to any other POI zone, but these are genuine POI zones right here. This fair value gap that price is actually going to seek every single day, not a supply zone or demand zone. But as we can see here, we pulled back into it and then we bounced right off of it. That's what we look for, okay? Now, it doesn't mean when price taps into the fair value gap, it shows you a lot of bullishness and bullish momentum, you buy into it. No. Just like the supply to demand zones, you want those 4 confluences. 2 of them are going to be strictly for you getting into the trade, and then the second and the other 2 are going to be strictly for TPs or what price genuinely could seek in that direction. In this case, we started slowing down. We started showing more bullishness than bearishness in this area. On top of that, that's the price action part. The second part, we shifted structure to the buy side, not only on the 1 hour, but also the lower time frames. Right here, after breaking this high point of this candle right here. Boom, entry. Done. Stop loss. All the way at the bottom of this 1 hour low point. TP. Could have been at this fair value gap. Could have been at this liquidity here. It could have been at this liquidity here. Whatever. Regardless, you had a beautiful move to the upside. Because, not just because of that POI zone, but because of those other 4 confluences. But the POI zone helped you take advantage of that so you were able to actually catch that move and not miss a beautiful opportunity. Now, before that, we also have the inversed fair value gaps. Which is essentially when price takes those fair value gaps that I just showed you, but it inverses it, okay? Now, what creates and what determines a inversed fair value gap, okay, really depends on how price closes. So right here, you see how the first candle, the third candle, wicks did not fill in the second candle's body. That means we had a fair value gap right here, okay? Meaning price should have just tapped into it. It should have just did this, boom, tap into it, and then come back down. But guess what? It didn't. And you already see what it did. It ran through it in the opposite direction, inversing it. And again, what determines an inverse fair value gap depends on how it closes, okay? If you mark out a bearish fair value gap like we did here, or a bullish fair value gap like right over here, price should do this. It should tap into it, whichever direction price is going, and formed it, and then push back up in that same direction. But if price breaks through it like we did here, and we close in the bullish instance, we close below the fair value gap, that forms a inversed fair value gap because we should not have closed below this bullish fair value gap. That creates an inverse fair value gap, and now if price is liable to pull back into it, retest, and drop all the way back down to the sell side, amongst that a market structure shift and a whole bunch of other things that are genuine confluences, not just the inverse fair value gap, okay? And then the same thing, but obviously vice versa, to the bearish fair value gap. Price should have just tapped into it and then dumped back down. Instead, we ripped through it to the buy side and we closed above. We closed above that 1 hour bearish fair value gap in this case. And because of that, guess what price did? It finally pulled back, and guess what? Rejected, retested, rejected, and then pushed all the way up, seeking more liquidity and inbounds to the buy side before doing some more bearish activity. This would be an instance of a bearish fair value gap that was inversed, okay? These are the things that I see more often, that I care more about when it comes to trading off of imbalances. I'm not a big fan of trading off of fair value gaps. I just never have been. But inverse fair value gaps, especially when markets shift structure and have genuine things to seek in that opposite direction, it's pretty clear as day. And again, with the inverse fair value gaps, when it comes to a bearish fair value gap like here, if price closes it above, I'm not talking about it just broke it. Price needs to fully close above this fair value gap. That creates an inverse fair value gap. And now all you have to do is wait for price to pull back, retest, reject, and to show you the confluences that we're going to head back up in that continue in that opposite direction. And then obviously it's going to be vice versa when it comes to the buy side fair value gaps, like we see over here. If price closes below, then that means we inversed it. And now all we have to do is wait for price to pull back, tap into it, retest, reject, so on and so forth. All right. Last but not least is going to be structural levels, okay? These are areas and levels that are going to be marked based on previous history, stoppage, rejections, and consolidation, because based on previous history, price tends to stop, consolidate, and reject off of this area. So just like any other POI zone, we need to mark it out so we can avoid getting screwed over, but we could also use it to our advantage when it comes to getting into a trade that we could miss an opportunity on if we are not aware of that being in the area, okay? Now, again, how you mark them out is you want to mark them out based on previous history, stoppage, and consolidation. So right here, you see how price continues to stop and reject and consolidate within this area? That lets me know that this area has a really strong level, a really strong structural level. Meaning if price gets to here, if we break through it strongly, we could see it continue in that direction, or we could see it retest and reject and head up in a different direction, or we could see it consolidate. Regardless, we mark this out, letting us know that based on structure, we could either stop and consolidate within this area, or we could continue in the direction that price decided to break it very strongly within that overall area, okay? And then we're going to do the same thing, down here. We can mark out right down here. We can mark out, right above here, right over here with that bearish, when I was talking about that other play that we had, with that supply zone. Okay, look at that. We had a nice level over here because price continued to stop and reject and retest within this overall area. And then guess what price did? Tapped into it, rejected, and pumped all the way up. You feel me? And that's basically just what that is. Okay. Now, how you want to trade with them is that it depends on the overall structure. Okay. So if we look over here, we can see that we clearly have a lot of stoppage within this area right here. Especially, guess what? When price pulled back and retested, rejected with this candle right there. Okay. Now, what determines if we can trade using it or not depends on how price reacts to it. We'll either see two things, which is right here, price taps it and keeps rejecting from it and then starts going flat and consolidating, or price breaks through it drastically, in this case to the upside, and we see it continue pushing in that direction. If we are able to get a strong break above, like a level right here, or below a level right here, especially structurally based, because a lot of them will be structurally based. That's the whole point of it. That's why I call it a structurally based level, structural levels. It lets me know that if we can get a strong break past this area, not only are we more likely and probably within that overall direction already shifted structure, but we are most likely going to see price seek more things in that direction. So if we were to break past this, so let's say, okay, we're mid-trade day. This hasn't happened yet. If we strongly break past this level, not only have we shifted to the buy side, but we're showing enough pressure, especially within an area that we tend to continue to stop at, that we're probably going to rip up further, meaning we could either buy into it or we could wait for the pullback and retest and reject like we did here, and like I saw some other people doing within this trade, and then take it up, okay? Or let's say to the sell side, if we broke this super strongly, we would have shifted to the sell side by forming a lower low after forming a lower high and multiple other lower highs. And we're most likely going to rip down to these lows down here and the other level that might be within that area. That's the whole point of it. Is based on structure because they are structurally based levels. This lets us know that depending on how price wants to react to it after tapping into it, whether that's strongly and viciously breaking through it or just slowly tapping it and then rejecting from it, it lets us know what we can expect. We can either expect price to consolidate, reverse, or just consolidate, or we can expect it to just completely rip through if it's volatile enough and strongly breaks through it, and we can expect it to continue in that direction. And that's the overall point of those structural levels. And more importantly, honestly, those are more important to me. Those I see work genuinely more often than just about any of those other POI zones. And those are the main things I kind of just try to focus on, you feel me? But ultimately, whatever works for you, it works for you. That's the video. Obviously, not every single strategic thing, not every single concept, or whatever you want to call it, is going to work for everybody, but these are the things that work for me, and which have been database since I ever started my Discord thing, and with the signals and whatever. I finished all my weeks and months between a 70 and 100% win rate, which I give all praise and all glory to God. So again, these are the things that work for me. It's not going to work for everybody, but it works for at least for some people that I work with. And it definitely, it works for me. You feel me? But yeah, ultimately, I hope the video was helpful. If it's still a little bit confusing, guess what? Tap the link in the bio, join the Discord. My mentorship is free, and you can get a one-on-one call directly with me. And we'll do what it do. You feel me? But I hope this video was helpful. Tap the link in the bio, join the Discord, join the TikTok, Instagram, etc., etc. God bless, and I'll see y'all next time.